These days, everyone's jumping into the investing play role. Now it's widespread. Investing is a game, and you can win or lose. It depends on your decisions taking in investing. But the victory is continuing the win situation as far as possible. To that end, you must be aware of the mistakes and possibilities in the game of investing. Everyone makes mistakes. It's a common scenario, and avoid making them yourself in investing. Learning from mistakes can help you build confidence and reach positive momentum toward your goals. If you're interested in financing, this video will be absolutely perfect for you. Get started on your investing journey with these tips and guidance to avoid investing mistakes. If you're interested in investing money, then you have to watch the video till the end. Number 1. Putting all of your eggs in one basket. Variety is the spice of life. One adverse event could damage your entire portfolio and financial future when you put all of your money into one investment. Reduce your financial risk by diversifying your portfolio. It will not impact your entire portfolio if one of your investments underperforms. In the past, diversification meant a mix of stocks and bonds among your assets. But nowadays, the meaning's more related to investing in mutual or exchange-traded funds. You can do diversification across asset classes, such as financing a portion in real estate, stocks and bonds, investing in multiple companies within one industry, and buying several sector funds. Diversification helps alleviate the stress of market confusion. It helps reduce your losses from equities, even stock market crashes. There, we can identify some methods to diversify your investing. Fund variety. Buying different types of funds, including purchasing shares in overseas companies, consisting of small shares of growth companies, investing in bonds, and buying shares in real estate investment trusts. These fund types act differently in different market conditions, so you can make it more likely. You can find analysis and information about mutual funds through websites like Morningstar. Asset allocation. This is the most popular form of diversification by far. Using elements of different investment classes, you can protect your portfolio from losing value. In this case, you can find the difference between a portfolio with stocks and bonds and one with only stocks. Diversifying asset classes. This is a wise decision in investing money. Having all your money in a single sector might seem risky, but it might be more challenging to do the same on a single stock. Letting emotions drive decision-making. Emotions in investing are just like oil and water. They never mix. For example, when the market is skyrocketing, people buy at inflated prices. Why? Because they want to attend the party. One way to prevent this common investing mistake is to acknowledge your feelings, but when you let your emotions rule, it blocks to focus on the bigger things. When fear and greed rule the market, they control your decisions in the market. Emotions are the #1 killer of investment return. Stock market returns may deviate wildly over a short time, but returns tend to favor patient investors over the long term. You must know that feelings are normal and you can control them. Then work to calm or counteract them. Looking at your financial portfolio might help that. Another mistake is falling in love with a company and forgetting that we bought the stock as an investment. Always remember that you bought this stock to make money, not to build bonds with feelings. It's normal to have peaks and valleys in the market. Refrain from beating yourself up if you have to watch it lose money after buying a stock or fund at a high price. You've made a mistake, and don't let it happen again. Identify the negative self-talk instead of getting down on yourself. Always try to learn from your mistakes instead of getting upset with yourself. An investor ruled by emotion always receives a negative return and panic sells, but patient investors always benefit from better control of emotions. Number 2. Being driven by impatience. Impatience is another investing mistake in investing. If you wish for greater returns in the long run, a slow and steady approach to portfolio growth is essential. Stocks may not experience the desired gains right away in the situations like investing for the long term. It can take months or even several years to play out when you discover a new strategy to implement in your portfolio and company. So you have to wait and observe patiently. But the reality is that investors buy stock shares and immediately expect to act in their best interest. When you desire to do something other than what it's designed to do in your portfolio, it can be an absolute disaster. It's better to keep your realistic expectations related to the portfolio growth and returns timeline. The magic of compounding always makes investing profitable. It just takes time to work. Number 3. Learning about stocks from the wrong places. Using the wrong sources to get stock tips or information is another common and costly investing mistake. Some ample experts are always ready to offer their opinions while presenting them. Financial experts are educated and endlessly correct. Think about stock analysts in investment firms. They can even get it wrong if they're qualified to render an opinion. If you're looking for general investment advice or guidance, government-backed sources and nonprofit organizations are excellent places to start. Consult a financial advisor if you need a good guide through the investing process. They will not only give you some of the answers and do the work for you, but they'll be able to provide you some guidelines. They'll remind you to relax and focus on the long term when losing your mind. Even if you're the most experienced and successful investor, it's impossible to predict the future. If an investment professional shows you a red flag on a specific outcome of your investment, you should consider it. Following lousy advice from social media is currently the most popping up topic. The misinformation on social media and surrounding investing and finance is common these days. It's essential not to take investment advice from those who don't know your financial situation. When someone on social media pressures you to start investing in a particular company, they're not clued in about your financial background. In such a critical situation, investing in an employer-sponsored retirement account might be more profitable than investing in a particular economy. Do your research when investing. Read up on the person giving financial advice or tips on TikTok or another social media platform and grab what you need. Number 4. Having unclear investing goals. Make sure you have clear goals as you go into investing. When you're ready to separate savings net aside, reasonable goals can drive you to victory. The real goal is investing to make more money. Money's a tool for meeting your other goals, but making investing all about returns is a common mistake. Do not try to chase high returns that also correlate with higher risk. Always try to meet your goals with less risky investments. Create your benchmark for investment performance compared to individuals' actual portfolios. The most important thing is you should align the design of your portfolio and performance to meet your own goals. Sometimes when you try business models, you'll need help understanding the reason for unclear investing purposes. You can build a diversified portfolio and study on it to avoid mistakes. Ensure that you thoroughly understand your environment and create your goals before investing. It's a problem when you need to know where you're going. It will end up somewhere else. The problem with unclear goals is the actual of investing is anything else. Number 5. Investing inconsistently. You can win the race easily if you go slow and steady. You don't need to worry about the ups and downs of the market. In this case, you can use a consistent investing strategy like dollar cost averaging. Dollar cost averaging encourages you to put a fixed amount of currency into the market at regular intervals, like weekly, bi-weekly, or monthly. When you place your money every month or week, unrelated to whether the market's doing well or poorly, it helps you avoid emotional buying or selling. It's happening because you're putting in the same amount of money even if the market is overheated, overpriced, or undervalued month in and month out. The market is always an unexpected platform, and you never know what's going to happen in the next month. But you're buying both the ups and downs by investing at regular intervals. So this will help you keep the average cost of your investments lower. Number 6. Constant watching the markets. Constantly watching the markets came up the most from all others. The general advice is to keep an eye on what's happening in the overall economy. The constant market movement and trying to follow along in real time will make you continuously check or change your investments, which is not good. Turning off your TV and stopping watching the daily market news is a much better strategy. If you keep doing this, it can lead to rash decision-making because viewing negative performance without context. Monitor the performance sparingly, whether good or bad. If you're working on long-term investing, it doesn't make sense to track your mileage in quarter-mile increments. It's better to ask whether you can hold these positions for an extended period of time before investing. It will be better to look at your investments every quarter, which is more than enough for investing. Investing should better not be boring.